Hey everyone, welcome to This Explainer. Today, we are diving into the absolutely fascinating and honestly kind of paradoxical Q4 2026 earnings report from Worthington Steel. I mean, on the surface, their headline numbers seem to completely contradict each other. So we're going to unpack exactly what happened, cut through all that noisy accounting jargon, and find the real financial heartbeat of this company.
Here's our roadmap for today. First, we'll meet Worthington Steel. Then we'll cover the Klockner acquisition, ride the Q4 financial roller coaster, unpack the impairment, and finally, look at the bottom line. Let's get right into it. Section 1, meet Worthington Steel, a modern metals processor.
To really grasp the financials here, you got to understand the sheer physical scale of this operation. Make no mistake, Worthington is way more than just some old-school metal bender. We are talking about a massive footprint. 37 facilities spread across 7 states and 10 different countries, all powered by over 6,000 employees. They're transforming metal through pickling, galvanizing, blanking, and lightweighting to create highly technical solutions.
And it's actually a pretty incredible story of evolution. Founded back in 1955, they had their first public stock offering in '68. Fast forward through decades of strategic growth, and they officially became a standalone company in 2023. Which brings us right to 2026, and arguably their boldest strategic move yet, the Klockner acquisition. Now, to decode their earnings, we need to know exactly how they make their money. It basically boils down to 2 distinct revenue streams. First, you have direct tons. This is where Worthington actually buys the raw steel, adds processing value, and sells it directly to the customer. Then there's toll tons, where the customer already owns the steel, and Worthington simply processes it for a fee. This distinction is absolutely crucial because in Q4, their mix shifted heavily toward the direct side at 65%, and as you'll see, that drove some major top-line impacts.
Moving on to Section 2, the Klockner acquisition, a defining step.
President and CEO Geoff Gilmore really hit the nail on the head when he called the completion of the Klockner transaction the largest acquisition in our history. He sees this as the ultimate catalyst for building a stronger, way more diversified platform. This isn't just an incremental step, it's a structural transformation of their entire global reach. And to put a real number on that ambition, 62%. During this fourth quarter, Worthington launched a voluntary public cash takeover offer for Klockner & Co. SE, and they successfully secured a whopping 62% of Klockner's outstanding shares. Gaining this controlling interest is a massive leap forward toward eventual operating control and global value capture. But as with all giant acquisitions, it comes with immediate upfront costs. And, well, those costs collided head-on with their Q4 reporting.
All right, Section 3, the Q4 financial roller coaster. Sales up, but earnings down?
So let's start with the good news, right? Net sales for the quarter came in at an impressive $929.2 million. That's a solid 12% jump year over year. Remember that shift toward direct tons we talked about a minute ago? Well, that's exactly what drove the surge. Higher direct volumes, particularly fueled by really strong demand in the automotive sector, pushed their top line up by over $96 million compared to the same quarter last year. More metal is moving and more top-line dollars are flowing in.
But here is the real mystery of this earnings report. Despite raking in nearly $1 billion in record sales, Worthington reported an operating loss of $57.6 million. Think about that. Just 1 year ago, in the exact same quarter, they posted an operating income of $66.4 million. That is a sudden, massive swing into the red during a period of double-digit sales growth.
I mean, it forces us to ask the obvious question, doesn't it? How on earth do you lose money when your sales go up so drastically? Did the core business suddenly become terribly inefficient? Or did the cost of raw materials just wipe out their margins entirely? Let's figure this out in Section 4, unpacking the impairment and solving this accounting mystery. Okay, here's the kicker. The vast majority of that operating loss came from a $94.5 million non-cash impairment in their electrical steel unit. Basically, they had to write down the paper value of goodwill and long-lived assets due to weakened demand in end markets, like industrial motors in Europe and the US, along with some delayed automotive launches. But remember, this is an accounting adjustment. It is not $94.5 million in actual cash walking out the door. Toss in another $15.5 million in one-time professional fees just for the Klockner deal, and suddenly standard operations start to look heavily distorted. When you glance at the official GAAP net loss, it looks like a painful hit of 98 cents per share, carrying all the heavy baggage of those impairments and acquisition fees. But if you strip out those one-time non-cash items, the adjusted net earnings actually reveal a 74-cent profit per share. Let me repeat that, a profit. The underlying core business didn't actually lose money on its daily operations. The profits were just temporarily masked by necessary financial bookkeeping.
Which brings us to Section 5, the bottom line, underlying health and future outlook.
Look, beyond all the spreadsheets and accounting jargon, the true health of a manufacturing partner is judged by its customers. And Worthington's blue-chip accolades are literally top tier. They were just recognized as a John Deere partner-level supplier for the 14th consecutive year. They've snagged the Schaeffler Supplier Excellence Award. And culturally, they've been named a top workplace in Columbus for 14 straight years. You simply don't maintain relationships with world-class manufacturers for over a decade if your core operations aren't delivering absolute excellence and reliability.
And you know what? Their balance sheet totally backs up that operational excellence. Even with all the massive moves they're making, they maintain what is essentially a financial fortress. They ended the quarter with $84.6 million in cash and cash equivalents. Over the last 12 months, they generated a highly robust $80 million in free cash flow. And as a major signal of ultimate confidence to their shareholders, they declared a consistent 16-cent quarterly dividend. So this is clearly a company with ample liquidity to fund its operations and reward its investors. So we've seen that the core direct and toll processing business is still highly profitable, and they are sitting on some seriously strong cash flow. Now, they face the monumental task of integrating the Kloeckner acquisition. With this newly diversified global platform, how will this bold strategy shape Worthington's fiscal 2027? Will all those Kloeckner synergies accelerate their top-line growth even further? It's going to be a fascinating year to watch. Thanks for tuning into this explainer, and as always, keep your eyes on the data.